One of the biggest misconceptions when it comes to the stock market is people feeling like the literal stock price, Apple selling for $267 a share, or Home Depot selling for, now we can't go up anymore, but you guys can see it's Home Depot, $358 a share, versus Nvidia selling for $186 a share. Most people who are not familiar with the stock market would say that Home Depot is the most valuable company, then Apple at $267 a share, then Nvidia. And ironically enough, it's exactly the opposite when we talk about which company is the most valuable. Because the share price, I'm not going to say it's completely irrelevant, because when you're deciding how much you're going to spend, if you're going to spend $1,000, you need to buy 5.5 shares of Nvidia. If you're spending $1,000 on Home Depot, you can get almost 3 shares. You get the point. So the literal price, I guess, matters to an extent. But the only thing that actually matters when you're looking at, do I think this company is overvalued or undervalued in comparison to other companies? Because valuations are all relative. What we're saying when we invest in a stock is we believe that the stock will be worth more in the future than it is worth today. But the worth isn't $358. Obviously, we know that's not the worth of the company. What you're saying when you buy Home Depot for $358 is you view the company to be worth $356 billion or more. That's the whole reason you buy it, is you believe that Home Depot in the future will be worth more than $356 billion. And what you're doing when you buy it is you are saying that, look, I would like to buy this company for $356 billion. Obviously, you don't have that amount. So you're buying 0.000001% of the company for $358 at this market value. That's what you're saying. If you were to buy this stock right now at this exact moment, this is what you're evaluating the company at. Now, with a company like Apple, their worth, and it might look weird because they both start with threes, Apple's worth $3.9 trillion, because this is 3,000 billion, which is a trillion. So Apple, although the share price is lower than Home Depot by a good margin, Apple is worth 10 times. So when you buy Apple at $267, you're not saying that you believe Apple is worth less than Home Depot. That's just ridiculous. Everybody, even if you're not familiar with the stock market, knows Apple is one of the biggest companies in the world. And that's the issue. It's a lot of people get hung up on the literal share price. They think, okay, I want to buy a cheap company. So when people go to look at cheap companies, they look at companies under $50 of share price. They look at companies under $10 of share price. And it's completely irrelevant, because there are companies that are worth billions of dollars that you can buy a share for $8 of, but that's just because the company issued out more shares. It's completely irrelevant whether you have 100 shares at $10 or if you have 10 shares at $100. It's still the same thing. If you have $100 worth of shares of that company, you own 10% of the company. I might have done the math wrong. 10 shares at $100. Yeah, it would be 10%. So regardless of whether it's 10 shares at $100 or $100 at 10 shares, 100 shares at $10, if you spend $100 within that company, you would own the same percentage of the company. So whenever you're looking at a stock, you need to decide, do I think Apple is worth more or less than, let's just say, $4 trillion? If you think it's worth more, then you should invest in it. If you think it's worth less, then you shouldn't invest in it. Now, you might ask the question, well, how do I know? How do I know if it's worth more or less? And that's a pretty complex question, because every person you ask is going to give you a different answer. Now, a few things you want to consider is, number one, the revenue, which we can have over here, which you can just do a quick Google search for and find the revenue, and the net income. Now, obviously, if you're investing in a company, let's say it's a small local coffee shop, what you want to know to decide if you think it's worth spending $100,000 to buy your local coffee shop is, what is the profit? How much are we making? And the net income for Apple in Q3 was 20. Let's just say a quarter, not a quarter, let's just say 25 billion. And everyone has to decide, okay, so if they're making $100 billion a year, Does that mean the company is worth $4 trillion? They also pay out a dividend. So that's something you also need to factor in. Is if I buy Apple, I own 0.00001% of a company that makes $27 billion per quarter. That company also, because I own the company, will give me 1%, so $2.67 per year. So not only would you be part ownership, you'd have, now you wouldn't get to make any decisions, obviously, because you don't own enough of it. But if you do own enough of Apple, and the people that own enough of it need to buy shares from you, so even if you only own one share, to some degree you are powerful, you get to be a part owner of a company that makes this amount of money, and they also are going to send you 1% of the stock price. Now Home Depot. Let's go to Home Depot. Home Depot makes $3.7 billion a quarter. And if we compare 3.7 to 27, 27 is about a 10x. It's more like an 8x. And Apple, ironically enough, 3 trillion versus 300 billion. Apple makes 10 times the money, and Apple is worth 10 times the share price. So when we're looking at well-established companies that aren't in the growth phase, that aren't, there's not a lot of boom or bust. Everybody knows what Home Depot is. Everybody knows what Apple is. Both of these companies are, we know what they are. They're going to probably continue to grow to a small degree. You know, we can look at the 1 year average, and it's actually down over 1 year, but not by much. But look, if you invested a while ago, you've made a lot of money. Now, something you do need to consider when you are looking at these stocks and looking at the charts is there's never anything that is inherently good per se. You know, a lot of people will say, look at Nvidia, it's been trending up a lot. And it probably is directionally true that a stock that is making money will most likely continue to make money. That seems kind of obvious, but there is no such thing as, you know, we'll go back to Home Depot. Home Depot is a little bit red over the last 6 months. Now, some people would look at that and say it's a good buying opportunity because they like Home Depot. Some people would go in the opposite direction and say, no, I don't want to buy Home Depot because it's going down. And vice versa. Some people would look at Nvidia and say, I don't want to buy Nvidia, it's at an all-time high. Other people would look at Nvidia and say, I do want to buy it because it's been going up consistently. So look, at the end of the day, you definitely can look at some of the company financials, because Nvidia makes less money than Apple by about $8 billion per year, but Nvidia feels like more of a growth company. So people value Nvidia a lot more than Apple. Not a lot more, but you know, $100 billion more. And the reason for that is because people feel like Nvidia will grow to being more than Apple. It's all about projections. Do you feel like X company will end up being worth more than Y company in short order? And that's what you need to decide. There isn't necessarily one specific metric that you can look at. It's not like you can just look at, okay, the PE ratio is below 20, it's a buy. It's not as simple as that. It's just, will the rest of the public, because you can get into a tricky area where a company, for example, like Tesla. Let me pull up Tesla. Tesla stock. And for example, Tesla. Why are they're only giving me this far back? Anyways, so Tesla wasn't even profitable at this point when they were worth. Right now, they're worth 1.3 trillion. But Tesla was worth getting close to. I believe they're pretty close to $1 trillion of market cap at this point in 2021. Tesla wasn't even profitable at this point. So, and they're barely even. I mean, they're making they're not even making $10 billion per year. And they're worth a lot more than Home Depot. Home Depot's making 10x what Tesla is, but Tesla's worth a lot more than Home Depot. And that's because people believe that Tesla will be worth more in the future. And more specifically, stocks can even become some sort of collectible. And you might say, what do you mean by that? A stock price, although it generally is tied to how valuable the company is from a monetary standpoint, how much is the company making, what are the future projections, et cetera, what's the inventory. The whole reason the stock price goes higher or lower is because the general public is valuing it at a higher or lower price. And that doesn't necessarily have to go hand in hand with that company being profitable. If everybody wanted to invest in Tesla and everybody viewed Tesla as just a cool thing to own, Tesla could become the most valuable company in the world, regardless of whether or not they're making money. So stocks aren't always inherently tied to profit. Because if they were tied to profit, then there wouldn't be a free market. It would just be, if you want to, it would be a math equation at that point. It would be this company makes $1 billion per year. For you to buy 1% of the company, you would have to give us XYZ percent of that. So that's another thing you need to understand is even if you look at all the right metrics, and even if you do predict a company to become more profitable than a competitor, Home Depot versus Lowe's, if you think Lowe's will overtake Home Depot, that doesn't necessarily mean that the stock will become more valuable. So that's something you should also consider. Now, at the end of the day, if you aren't sure about what to do, let's get to we're trying to get to QQQ. So QQQ is kind of the gold standard in terms of ETFs, and what that means. That essentially is just all the big companies, all the big, specifically tech companies, but they also own other stuff. If you invest in a QQQ or an SPY, two of the biggest ETFs, which they just own everything, it's pretty safe. As you can see in the last year, up a good amount. Oh, we don't want it to be that zoomed in. Okay. Trying to go to all time. Alrighty, so anyways, it's even cutting off part of this, but as you can see, there are a lot of dips, even with an ETF. Nothing is... If you buy a stock today, there's no guarantee it'll be up tomorrow. Probably a 35% chance it'll be down tomorrow. But if you invested all the way back here in 2000, you're up a lot. A lot. And if you invested in the inflation bubble or the COVID bubble, it's kind of irrelevant because you're up so much, even with the tariff bubble right here. I don't know why I'm calling them bubbles. Tariffs aren't really a bubble. But if you invest in something like QQQ or SPY, which is just the whole market, the whole United States market, if you trust the United States and if you think we're going to be a country, then SPY and QQQ is a pretty good bet, because the only way it goes to zero, the only way it tanks, is if all of a sudden there are no companies, if all of a sudden somehow we became a communist country. But until that happens, QQQ and SPY are going to be, for my opinion, great investments.